Welcome back to the Daily Journal. So we are reviewing Ethereum's price action from the New York session on Friday. We are trading the 10 a.m. continuation model. What you may notice here is that it's 11 a.m. for this 4-hour candle open. And that's because I'm on the perpetuals chart, which differs by 1 hour to the futures chart. So when I trade futures with my funded next, I'm trading NASDAQ, and that's the futures. So it opens at 2, 6, and 10 a.m. Eastern time for the 4-hour charts. But when I'm trading crypto, I'm trading with Bybit, and the perps chart differs by 1 hour. So I still use the CME futures chart for a higher time frame bias. I believe that market leads for the most part, and so it's always worth checking out, because what you may find is that sometimes you won't get a sweep of liquidity, which I require for my model in certain instances. You'll find it on the CME futures chart, but you won't find it on the perps charts. A good example is the low that Bitcoin made in April. Go compare the CME futures charts to the perps charts, and you'll find some evidence there. So I'm still trading the 10 a.m. continuation, but we'll just call it the 11 a.m. for the sake of this example. But I'm always paying attention to those times, 2, 6, and 10, because it's the futures chart that I'm looking for. Nonetheless, we'll look at the perps chart here, because this is what I would have executed on. So when we drop back down, or rather drop back to the weekly charts, I'm just looking for liquidity here. So you can see we had initially taken out that liquidity over here, and then we went and swept that liquidity here. Now we hadn't yet confirmed it was a sweep, because we are trading the continuation down here. It was only confirmed as a sweep once the candle closed above this level, which happened on Sunday. We're trading Friday, so we're anticipating that, right? Which is why when you have your hard time frame liquidity levels marked out, when it gets triggered, that's when you can drop down to the 4-hour, right? So once this previous week low was triggered on the Tuesday, I'm on the 4-hour charts and waiting for setups. So once price traded up to these levels and traded back down, you can see that the next thing I was looking for as a trigger was this previous day low. So we're on Friday here. You can see the previous day being Thursday was taken out. And now I'm looking for what price action is going to do at the New York session. What you'll notice is that price also rebalanced this inefficiency, this wick. It dropped down to about the 0.75. And we can then drop down to the 50-minute charts. And for this part, I'm going to rewind the clock. Going up to the New York session, so I can show you what I'm looking for with my model. So we've taken out sell-side liquidity on the weekly. We've also taken out the daily. So going into the New York session, let me walk you through my process, right? That is the New York open. I'm looking for manipulation here. If we get manipulation, I'm looking for continuation at 10 a.m. So there's the previous day low. Here is the short-term low, that being pre-market. And if this gets taken out, I want to look for confirmation that market makers have been accumulating long positions, such that when price manipulates this low and confirms this momentum reversal by closing above the high, the swing high that delivered the manipulation to sweep the lows, I can then look to trade alongside the market makers as they distribute those long positions to the engineered buy-side liquidity. So what do I mean by engineered buy-side liquidity? Well, what you'll notice here is that we have relative highs and swing failures the whole way down. And so what that means is that there's buy-side liquidity resting just above these swing failures. Because if you're going short, you're looking for the swing highs as your invalidation, right? So what I can see is relative highs, that's buy-side liquidity at the top of this consolidation. The whole way down I can see it, and I can also see inefficiencies. So I know that market makers are accumulating positions on the way down, and I'm looking for them to confirm to me that are pairing orders in discounts. Once I've got the accumulation side confirms, as well as the manipulation, I have a high degree of certainty, right, or probability, I should say, that they're going to distribute those long positions and I can trade alongside the market makers. That's the whole premise of my model. Okay, so let's watch to see what's happening, because I'm looking for this candle to reverse and then to trade the 10am continuation, which is a much higher probability. I don't have to try to trade this 1 minute down here, right? That's, when you've got price, trending to the downside, trying to trade the 1 minute reversal here is just risky and takes a lot of skill and experience. So starting off, just look for the continuation, and eventually you'll get a lot better at reading those reversals. But quite frankly, for somebody who came from just trading reversals because I always thought the risk reward was better, turns out trading continuations not only is higher probability, but also offers you a higher risk to reward, right? Because your invalidation is often a lot closer to your entry than it would be on a reversal, because the reversal is where the manipulation happens. So when I get a 50-minute close like this, having swept liquidity, previous day low, pre-market lows, then we get a change in state of delivery, which is here, but I'm just going to use this breaker block for two reasons. One, price has expanded, or displaced rather, well above this area. I don't want to see price trade back down to this low. It could potentially, but then it would have to be an immediate rebalance, which is to say that price drops lower and then bounces and it just forms a massive wick. But here's the thing. This is a breaker block. Low, high, low, low, break. This is a breaker block. So this is essentially invalidation down here. And price should come back down to this breaker block. So this is the second reason here, is because it's also the opening level of this candle. When you get your change in state delivery lined up with your time-based level, that's the confluence that you really want to look for. So this is the change in state delivery. It's a breaker block. Fantastic. I can enter by setting a limit at this point. I can use 50% of this wick, although I'll use this the low here, because this is a breaker block. Price could trade down for an immediate rebalance, remember? And if it drops lower than that, that'll be manipulation, but that's seldom going to happen. But I'll use 50% in any case. I'll probably calculate my risk here, then widen my stop loss just below 50%, because I can still get a 2-hour trade, and that's solid. Now here's the thing, is that if I look to the left, all I see is swing failures. This is low resistance liquidity. And here are relative highs. So we've got low time frame targets, we've got high time frame targets. And the way I'm looking at this is just one big market maker model. But for the session that we're trading, this low hanging fruit is all we really need. But to get an idea of what the targets are for this market maker model, we can use the standard deviation from the swing high to the swing low, and you'll notice that the full extension, because typically, and look at that, the low hanging fruit lines up with your first standard deviation zone. The high time frame targets line up literally perfectly with the full extension of your standard deviation. So since this is on the perp chart, if I were to be trading that, I would just hold all the way for this full projection of the market maker bar model of the distribution side. So we could execute that, and you can see how price traded straight back to this breaker block and expanded away. What else could we do if we didn't want to trade that reversal entry? We could also trade the continuation, which is once price drops into, you can see how price had a shallow retracement, probably 50% of that level. I'm just going to clean this up a bit. You can see as price made the wick of that candle, this is, by the way, the 10 a.m. open. I just have to adjust it because the time is slightly different. So you got to play around with the timing for this candle to show you the 10 a.m. open, because we want to see that wick formed, right? And once that wick is, the only way we can confirm that wick is when this, essentially another change in state delivery after it's trading, expanded retracements, and then we're looking for more expansion. So with it, rebalancing this inefficiency in the form of a wick. There's the 50% level respected. There's your shift. And that could be your entry because this is now a protected low. And hold on to your high targets. And there's a 4-hour trade. Alternatively, what you could do, if you wanted a better risk reward, is use the order block, which is over here. And now your 4-hour trade goes to a almost double. But let's just say you weren't interested in these high time frame targets and you're more interested in trading the 1 minute as your execution. This is typically how I would trade, given the fact that my time zone means that this is 5 p.m. now for me. I like to get my trades in, and typically when I'm trading with my funded next, I've got to be at the markets by 3-4 p.m. So let's just drop down to the 1 minute because now I have my shift, my change state delivery on the 50-minute charts. That means my bias is confirmed. I've got my low time frame targets, right, my low hanging fruits, and now all I need to do is trade the continuation. So what I wait is for something like an order block, a fair value gap. And what I love about this is that it's also the base right at the time-based level. So I'll look for price to, it's expanded, I look for retracements, and then continuation, and that's when I get involved. And the reason being is that if price trades away from this, that becomes a protected low. And that's important because we need a protected low for invalidation. So you could market order straight in, or you could use this order block. There's the low, and those are those targets. And there's a nice 4-hour trade. Right? So we've also got the 10 a.m. coming up. 9:45 is my favorite time to enter trades. So this is this is a high probability trade. And this low is protected. So I'm very happy with my stop loss there. And with time, you'll learn that despite price trading very close to your stop loss, it can even come right to it. But once that low is protected, you're good to go. Now let's just say, for example, I have missed that entry for whatever reason, and I'm looking to get on side because my targets are still intact, so longs are still valid. What I need to do is wait for one of two things. Price needs to trade into an inefficiency and or sweep of liquidity before another change in state delivery, essentially, right? So I'm looking for a swing low. There's no fair value gaps here. This is a swing low forming. Let's see what price does. Okay, there we go. So now what I can do, in an instance like this, I prefer just to use this point over here. You can use this, but you know where price is going. Your entry is the least important part. You just want to make sure that the invalidation is correct. No point having a great entry if you get stopped out. So that's where I'll get confirmation if price can trade it. And I'm really loving this. Why? Because expansion met with expansion is a reversal. Look at the wick that it's forming. There it is. You can trade, you can do a market order in, your stop loss at this low. Our target's there. There's a nice 3-hour trade. Let's see how price trades. And let's give it some time. Okay, so it's probably lunch now. Yeah, so we're going into lunch. Price is consolidating, which is no problem, right? We've expanded, we're consolidating. And you can expect continuation from this point. Okay, and you can see how my low there was protected. And it should eventually get there, and there it is. So let's also just look for what price, where did price trade to? Well, we just were ranging and then formed another swing low down here. But where else did it go to? It also went to that order block. So that was another potential entry for you. Knowing that you have this protected low, you know where to put your entry, and now you know where to put your stop loss. That's a nice 6-hour trade. And if we drop, or rather go back to the 50-minute charts, what you'll find is that wasn't just a random place where price went to. That's an inefficiency which it traded to the 0.5. So there's multiple different ways to enter. There's multiple different ways you can get on SARD, so long as you know where price is going. And then secondly, your invalidation. Remember, as RCT says, once you know where price is going, your entry is the least important part. Find your drawn liquidity, find the invalidation points, and get on SARD. So let's see what price did for the remainder of this day. And I think eventually get to and look at that. That's stunning. The wicks did the damage, the bodies tell the narrative, and there's that market maker model delivered. See you guys next time. Cheers.